What if the 2008 financial crisis wasn't a random accident? What if it was a meticulously engineered heist by the global elites to suck trillions from your pocket into theirs? Picture this: Wall Street titans, central bankers, and shadowy financiers pulling strings behind closed doors, turning your home, your savings, your future into their personal casino chips. They called it a market correction. I call it theft on a galactic scale. You feel it today, don't you? That nagging inflation eating your paycheck, the crushing student debt chaining you down, the job market that's a rigged game where AI and outsourcing leave you scrambling. It's no coincidence. The 2008 collapse set the stage for this endless grind, where the rich get bailouts and you get the bill. They transferred over $10 trillion from Main Street to their offshore accounts, laughing all the way. But here's the unfiltered truth. This wasn't fate. It was design. Stick with me and I'll peel back the layers, expose the mechanisms they don't want you to understand. By the end, you'll see how money itself was invented and reinvented to control you. Quick check-in, where are you watching from? Drop it in the comments. Let's build this community of truth seekers. And if you're ready for more exposes like this, hit subscribe now. The elites hate when we wake up. Let's make them sweat. Let's rewind the clock. The official story of 2008 starts in the early 2000s housing boom. Banks loosened lending like never before. Subprime mortgages exploded, loans to folks with shaky credit, no down payments, teaser rates that ballooned later. Why? Greed. Wall Street packaged these risky loans into shiny securities, sold them worldwide as safe investments. Rating agencies slapped AAA stamps on junk. Everyone got rich. Until the music stopped. But dig deeper. This echoes the roaring 20s before the 1929 crash. Back then, wild speculation on stocks bought on margin, borrowed to bet big. Banks fueled it with easy credit. When reality hit, markets tanked 89%. Unemployment soared to 25%. The Great Depression scarred generations. Sound familiar? Today's stock market hype around tech bubbles and meme stocks mirrors that frenzy. Borrow cheap, pump values, crash hard. Fast forward to post-World War II. The Bretton Woods system pegged currencies to gold, US dollar as king. Stable? Sure, until Nixon ditched gold in 1971. Fiat money flooded in. Print at will. Inflation spiked in the 70 seconds. Oil shocks. Stagflation. Central banks saved us with rate hikes, crushing workers. Parallel to now? Absolutely. Post-2008 quantitative easing pumped trillions into banks, inflating asset bubbles while wages stagnate. Your dollar buys less. Elites' assets skyrocket. Remember the savings and loan crisis of the 80 seconds? Deregulation let thrifts gamble on real estate. Over 1,000 failed, costing taxpayers $160 billion. Insider deals. Fraud. Rampant. Regulators asleep. Sound familiar? Silicon Valley Bank collapsed in 2023. Same playbook. Risky bets on bonds. No oversight. Bailout whispers. The system learns nothing, or worse, repeats on purpose. Go further back. Money's invention itself screams control. Ancient Mesopotamia, 3000 BC. Clay tablets tracked debts, temples as banks. Kings forgave debts in jubilees to prevent revolts. But elites weaponized it. Rome's coin debasement fueled wars, impoverished masses. Medieval usury bans kept power with the church. The Renaissance birthed modern banking in Italy. Medici family pulling puppet strings on monarchs via loans. Colonial America. British crowns forced colonists to use scarce sterling, sparking revolutions. Post-independence. Hamilton's central bank centralized power. Jackson fought it, calling it a hydra of corruption. He won temporarily, but elites regrouped. The Federal Reserve's 1,913 birth, A midnight deal on Jekyll Island by bankers like JP Morgan. They sold it as stability. Reality, boom-bust cycles benefiting insiders. Modern parallel, crypto's decentralized promise, it's co-opted. Big players like BlackRock hoard Bitcoin ETFs, turning rebellion into another control tool. Sound familiar? Just like how elites hijacked the internet from free info to surveillance capitalism. The 2008 seeds? Deregulation waves. Glass-Steagall repeal in 1999, mixed commercial and investment banking, firewalls down. Commodities Futures Modernization Act 2000 unleashed derivatives unchecked. Enron's 2001 collapse, warning ignored. Fraudulent accounting, off-balance sheet tricks, yet no reforms. Instead, acceleration. Today's pain. Soaring national debt at $35 trillion, personal debt topping $17 trillion. Inflation officially low, groceries say otherwise. Job instability, gig economy traps you in precarity. Elites engineer this, crises consolidate their wealth. In 2008, top 1% captured 95% of recovery gains. Parallel to post-depression, New Deal helped, but real power stayed with bankers. Historical cycles show money evolves to entrench elite control. From barter to blockchain, it's about debt peonage. You borrow to live. They profit on interest. The 2008 collapse, not anomaly, deliberate chapter in this saga. Now, the twist that flips the script. The real engine behind 2008 wasn't just bad loans. It was the hidden beast. The derivatives market fused with the shadow banking system. These weren't your grandma's stocks. Derivatives, bets on bets, insurance on assets without owning them, shadow banking, unregulated finance giants operating in the dark, away from Fed oversight. Enter the key enablers. Alan Greenspan, Fed chair, championed deregulation. He called derivatives risk dispersers. Ha! They amplified chaos. Then, the Commodities Futures Modernization Act snuck into a must-pass bill by Senator Phil Gramm. Backed by Wall Street lobbyists, it exempted derivatives from regulation. Result? Explosion from $72 trillion in 1998 to $684 trillion by 2008. But the person who lit the fuse? Hank Paulson, Treasury Secretary, ex-Goldman Sachs CEO. He orchestrated the bailouts, saving his old firm while letting Lehman burn. Coincidence? Hardly. The mechanism, credit default swaps, CDS, insurance against mortgage defaults. Firms like AIG sold trillions in CDS on mortgage-backed securities, MBS, betting the housing bubble wouldn't pop. When it did, payouts crippled them. This wasn't oversight, it was orchestration. Elites knew the risks, bet both ways. They shorted their own products via shadow entities, hedge funds, investment vehicles hiding trillions off books. The stakes? Global economy as collateral. Curiosity piquing? Good, because the receipt for this heist is wilder than you think. All right, let's dive deep into the guts of this machine. The derivatives market and shadow banking system, the twin engines of the engineered collapse. I'll break it down simple, with analogies, real examples, and numbers that'll make your blood boil. This is how they pulled off the $10 trillion transfer, turning your hard-earned money into their eternal slush fund. First, understand derivatives. Think of them as side bets at a poker game. You don't own the cards, you wager on outcomes. Credit default swaps, CDS, like buying fire insurance on your neighbor's house and maybe lighting a match. Mortgage-backed securities, MBS, banks bundled thousands of home loans into packages, sliced them into tranches fancy for layers, sold to investors. Safe top layers paid first, risky bottoms last. Shadow banking, the dark alley of finance. Traditional banks take deposits, lend under rules. Shadow players, investment banks, hedge funds, money market funds, do similar but unregulated. They used short-term borrowing, repo markets, to fund long-term bets, creating illusion of liquidity. When trust vanished, runs ensued, like old bank panics, but digital and massive. How it worked? Step 1. Inflate the bubble. Post 9/11. Fed slash rates to 1%. Cheap money flooded housing. Lenders pushed adjustable rate mortgages, ARMs, low intro rates spiking later. Subprime borrowers? No problem. Approve everyone. By 2006, subprime MBS hit $600 billion annually. Shocking number 1, housing prices soared 124% from 1,997 to 2006, far outpacing incomes. Step 2, securitize and derivatize. Banks like Countrywide originated loans, sold to Wall Street, Goldman, Lehman. They created MBS worth trillions. Then CDS on top. AIG issued $500 billion in CDS by 2008, ensuring MBS without reserves. Analogy. Building a Jenga tower with rotten blocks, then betting it'll fall while selling stability certificates. Greed fueled it, bonuses tied to volume, not quality. Moral hazard, banks offloaded risk via securitization. Originate to distribute. No skin in the game. Parasitic finance at its peak. Investors worldwide gobbled MBS, thinking diversified. Pension funds, sovereign wealth, all hooked. The illusion cracked in 2007. Delinquencies rose as ARMs reset. Subprime defaults jumped 200%. Bear Stearns' hedge funds tanked, holding $20 billion in subprime MBS. Fed bailed via JP Morgan. But the shadow system unraveled. Money market funds holding short-term debt from shadow banks faced runs. Breaking the buck, funds dropping below $1 share. Enter the collapse. Lehman Brothers filed bankruptcy the 15th of September, 2008, $639 billion in assets, largest ever. Why let it fail? To scare Congress into bailouts. Paulson demanded $700 billion TARP, but total commitments? Shocking number 2. Up to $23 trillion in guarantees, loans, bailouts per government watchdog. That's $70,000 per American. Your tax dollars propping elites. Derivatives amplified. Notional value face amount of global OTC derivatives. Shocking number 3. $684 trillion in June 2008, 10 times world GDP. U.S. banks held $300 trillion. When MBS values plunged, CDS triggers cascaded. AIG needed $180 billion bailout. Taxpayers footed it. Real-world examples, Goldman Sachs. They sold MBS to clients while shorting via CDS. Profited $4 billion on the crash. Engineered? Absolutely. Or Citigroup. Hid $40 billion in subprime exposure off balance via shadow vehicles. Find later, but damage done. Analogies abound. Imagine a casino where house bets against players, rigs, slots, then gets bailed when it loses. Or a pyramid scheme. Bottom borrowers pay top investors until recruitment stops. Housing was that pyramid. Shocking number 4. Household wealth loss. $19.2 trillion from 2007 to 2009. Homes foreclosed, 8 million. Families ruined. Suicide spiked. Unemployment hit 10%. 8.7 million jobs vaporized. The transfer. Bailouts went to banks, who hoarded cash, paid bonuses. Top execs got $20 billion in 2008 alone. Meanwhile, you faced austerity. Global? Europe tanked. Iceland bankrupt. Engineered collapse consolidated power. Big banks swallowed small. Now, too big to fail forever. Emotional toll, greed blinded, illusion of prosperity, shattered lives. Parasitic, Wall Street sucked $7 trillion in profits pre-crisis, left wreckage. Moral hazard enshrined, risk privatized, losses socialized. Shocking number 5, GDP drop, 4.3% peak to trough, deepest since World War II. Recovery, elite's wealth doubled, yours lagged. This mechanism, derivatives and shadow banking, wasn't accident. It was the evolution of money as control. From ancient ledgers to digital swaps, elites designed systems to extract, collapse, rebuild stronger in their image. They bet on failure, win either way. You, collateral damage. Wake up, friend. The stakes are higher now. Post 2008, the system's faster, more global. Derivatives market, balloon to $1, quadrillion notional. Shadow banking, thrives unregulated, fintech cloaking old tricks. Next collapse, not if, when. AI, trading, crypto volatility, climate debts, triggers everywhere. It'll dwarf 2008, vaporizing retirements, sparking unrest. The philosophical lesson, denial is deadly. We trust institutions built on borrowed time, fiat illusions, endless debt. Money wasn't invented for freedom. It's control disguised as convenience. Elites engineer crises to reset, consolidate. We're pawns in their game. But you can fight back, question everything, diversify beyond their system. Knowledge, skills, community. Share this video with skeptics in your circle. Let's expose the strings. Final call. Hit like if this shook you. Subscribe for weekly unfiltered truths. And tell me in comments, are we wiser now or walking the same path in better suits?